India's most preferred investment tool is FD. Can it provide the inflation beating returns? I am Darshan. Welcome to the show on personal finance where I talk about money, savings, investments. And today we will talk about investment difference between FD and mutual fund. This show is for a common person like you and me to understand the complex financial terms in simple English. Stick on till end of the episode where I share a bonus tip that encourages you to take up the market related investments. The concept of my money is safe in bank, which has been followed from generations to generation when the interest rates were as high as 12%. Given the current FD interest of hardly 4 to 5% and steep inflation rate at 6%, can your FD beat the inflation? Let's find it out. We are all aware how FD works. For those who have started out, hear me out. Let's say you have 1 lakh rupees that you have kept in your bank for a certain duration of 1 year with 5% of interest. For banks to give you the 5% interest, what they do is take that money and invest in a low risk project such as government infrastructure project or government backed project in a safe way. The small percent of ROI derived from such investment is passed on to the consumers who park their money in the bank for a certain duration. This certain duration can range from 3 months, 6 months, 1 year to 5 years. Now you know how FD works. Let's get into mutual funds. Mutual funds are accumulation of many individual company stocks such as Infosys, Exide, Tata and many other companies. When you buy a mutual fund for a certain amount, you buy certain portion of those companies stocks in that basket. In many cases, the mutual fund investment return on average 8 to 12% over a long term. As companies reinvest those money in the project which generate revenues. We are all aware of one famous line, investment in mutual fund. I give you 5 seconds to complete the sentence. 1, 2, 3, 4, 5. Okay. Let me complete the sentence for you. Investment in mutual fund are subject to market risk. Please read the brochure for more details. We have seen a glimpse of how mutual fund works. We shall explore in the future podcast. We shall evaluate your investment in FD and mutual funds on 3 factors, that is returns, liquidity and tax returns. I will share you another bonus factor at the end of this episode as it determines your capacity to invest. Point 1. Returns. As I explained in the previous section about FD and mutual funds and how it works, it's very clear that mutual fund return more bang for your buck. But why are people not investing in mutual funds? As in FD, bank guarantees the return upfront on your money invested for a certain duration. But whereas in mutual funds there is no guarantee on your investment and it is governed by the stock markets up and down. But when investment are considered for a long term, the ups and downs will average out and give a better return. Here, patience is a most important asset while investing in the stock market. Point 2. Liquidity. Mutual funds are highly liquid. The units can be redeemed at any time with few clicks of a button, and the money will be deposited in your bank account within 2 or 3 working days with almost no charges. Whereas if the FD is broken before the maturity date, then a penalty of 0.5 to 1% needs to be paid back to the bank. This penalty will be deducted from your return amount. Point 3. Taxability. A true investor will look into the returns after paying taxes. In case of FD, the amount generated will be taxed as per your tax slab. If you fall under 20% of income tax slab, then you will pay 20% tax on FD returns. This applies to the people falling under 30% as well. In mutual fund taxation, we'll consider two aspects: long term of 3 years and above, short term of 1 to 2 years or less. In long term investment, long term capital gains are levied on a debt fund investment. Here, irrespective of your income slab, you need to pay 20% of tax. Whereas in a short term investment, less than 3 years are taxed as per your income slab of the investor. That is, you will pay 20% of the tax if you fall under 20% of income tax slab. Let's discuss the bonus tip. But before that, do check out www.buytherupee.com for more articles and podcasts on personal finance. Also, comment in the section what topic you would like to know more. Until then, keep following the podcast. Let's dive back to the bonus tip. Risk profile. One of the first criteria of any financial investment is how safe my money is. That way, a guaranteed safety factor is one of the biggest benefit of FD. There is a certain risk associated even with FD. Banks have certain insurance on your FD. That is, in case if a bank defaults, there is a amount that is backed up by the insurance. Let's say you have invested 10 lakhs in a bank and bank defaults. In that case, you shall receive only 5 lakh as compensation from the insurance. Always do read the fine prints. In case of a mutual funds, the returns are subjected to market ups and downs. There is no guarantee given. Only an investor can decide if he wants to withdraw during a crash or keep invested for a long term. As bottom line, we refrain from investing in mutual fund and instead put our money in the bank FD, thinking FDs are much safer option of investment. But in a long term, mutual funds have a capacity to provide FD beating returns, liquidity, and be more tax efficient. Investing in a stock market, even during ups and downs, is more of an emotional journey than calculating your return on investment. Always do your due diligence before investing. If you have made till the end of this episode, that means you really want to take control of your finance. Keep safe and peace.